Every single month, I do a video talking about the two most undervalued stocks to consider in a specific month. I have done one in September. A lot of you actually enjoyed it. I talked about two retail stocks that I believe are extremely undervalued in the market, but some of you were actually upset because I have a lot of dividend investors on the channel that followed me, maybe from my Verizon or AT&T videos or many other videos I did on many dividend stocks. So I decided to try something new and actually do another series of two undervalued dividend stocks to consider for a specific month. This is gonna be the first one for this month. If I get good feedback, I'm gonna do more of them every single month. So if you enjoy it, please let me know down in the comment below and press the like button if you enjoyed it in general. I'm going to talk about two of them in this video. The first one is a high quality REIT that I believe is actually trading at a discount, and the second one is I believe is a low risk, high return kind of bet with over a 9% dividend yield, and it has a pretty amazing option strategy that I used to implement. I'm going to share it all with you in this video. Now, the first stock that I actually used to own, I bought it in 2018, was NNN, which is triple net. Triple net is a pretty amazing REIT. They have the triple net lease on many properties. The stock is sitting at $39 per share, pretty much flat at the same price it was trading at somewhere in 2013, excluding dividends, of course. The company has been a disaster lately, but not just triple net, also realty income. A lot of the apartment REITs, which I have been buying apartment REITs in my own portfolio. I talked about many of them here, something like Avalon, Mid-America, and there's many other apartment REITs that I believe are extremely attractive. But even triple net is in my watch list, and it's actually starting to look very, very attractive, and it's mainly bad sentiment from the Fed hiking rates. Whenever the Fed hike rates, the yield that those REITs are offering is going to be less and less attractive. But the Fed's not gonna keep hiking rates forever. Eventually, rates are gonna come down, which is why REITs right now offer a pretty amazing dividend yield, but they also offer some price appreciation, and this has been very rare because over the years, REITs mostly offer the dividend, not much price appreciation. But I believe this is one of the few times where a lot of the dividend stocks, and especially the REITs, are offering a 6% plus dividend and also some potential share price appreciation. And I believe triple net lease is actually one of them. A lot of you are familiar with the companies. They are very diversified among many different lines of trade in pretty resilient stuff: convenience stores, automotive, restaurants, health and fitness, something like wholesale club, equipment rental with United Rentals, and many other lines of trade. But the company does have some risk exposure to some specific names, especially something like Camping World. Camping World is, they lease RVs and stuff. Although it's not going out of fashion anytime soon, but there's over 47 properties for Camping World, and the company has not been doing very well. So this is an area of concern. Another area of concern are the theaters. They have AMC theaters. It's around 2.8% of the portfolio. They have, a few other names. They have something like Best Buy, although Best Buy is fine, but they have, a few other risky names. Around 5 or 6% in total exposure to theaters. A little bit concerning, but it's not too bad. I mean, most companies, they have exposure to such things. Even Realty Income actually does have exposure to AMC and Regals. But again, triple net is diversified mostly within resilient industries. Something like 7-Eleven, Mr. Car Wash, LA Fitness. That's pretty amazing stuff. And most of the leases expire after 2031. The weighted average lease term is something like 10.2 years. So there's a very long time until those leases actually expire. That doesn't mean that some tenants cannot default. But I don't personally believe this is such a huge risk with something like, triple net lease. I think it's a much bigger risk with something like FPW. I'm not very concerned about that with triple net lease. I think dividend is safe. I think the company is pretty amazing in my opinion. Now, one of the things that I like about triple net, which is one of the reasons why I owned it in 2018, was mainly the capital allocation strategy. The company is a little bit more careful with diluting shares. You have other REITs like Realty Income, which I actually like very, very much. It's also on my watch list, Realty Income. But Realty Income is a little bit more aggressive within issuing shares. They both actually grow FFO, pretty much the same level. Triple net lease grows FFO per share around 4 to 5%. And it's the same thing with Realty Incomes. They grow at 4 to 5%. But again, as you can see from this chart, triple net lease does dilute stock, but nothing too crazy. They're a little bit more careful with that, which is why I like it very, very much. And if we look at the dividend of the company, the dividend, if you look at it over the last 10 years, is sitting at around 5.77%, so pretty close to a 6% dividend for triple net lease, the highest pretty much it has traded at in a while. The other time it traded higher was in March 2020. It traded as high as something like 8% dividend, and the 2008 financial crisis it traded as high as 14% dividend. I don't believe we're personally getting something like that. It would be crazy because triple net has a good debt profile, good payout ratio, pretty diversified among many resilient industries except the theaters and maybe camping world, which is actually is not bad, but I don't believe it's the best thing to have exposure to. But again, the company is safe in my opinion. I think the dividend is not bad, offering 5.7%. I'm going to give you my valuation model on it very, very soon. But if we look at the valuation of where the company is trading at, it's trading at 12 times FFO per share, which is the best metric to use valuing REITs in my personal opinion. 12 times, it's one of the lowest on a historical average. The lowest they are trading at again since March 2020, and where it was trading at somewhere in late 2009. So this is why I believe, again, not only you get a pretty close to 6% dividend, but also some kind of price appreciation. And this is how I think about price appreciation with triple net lease. I took the current FFO per share, funds from operations per share, which is around $3.24, and I put in around 5% growth over the next 5 years. Now, the main reason I did that is because I looked at the history of the company. They were able to grow the FFO per share around 5.5%, 6%, 7% on historical average. Now, this year has been a disaster. It only went up 0.87%. So pretty much flat, but on a historical average, it's been around between 4 to 6%, even 7%. So I used a 5% number over the next 5 years, and I think most of you can actually agree with me that this is pretty conservative. Now we take the 4.14 of FFO per share. We looked at the average FFO multiple, which was around 16 times. Now it's trading at 12 times, and we're only betting that the multiple of triple net lease is going to get back to the historical average. Now the highest it traded at was around 22 times FFO. I'm not betting on that. I'm just betting that over the next 5 years, rates are likely going to be lower. I don't know over the next year or 2 or 3 years, but I'm pretty sure with that situation we have, interest rates are not going to be close to 6% in something like 2027 or even 2028. I would bet on them being closer to the neutral rate of 2%, which is going to be very, very attractive for triple net lease. But I'm just betting on the company getting back to the historical average of somewhere around 16 times, FFO per share. So if I take the number that we came up with and we time it by 16 times FFO per share, we get around $66.24 per share. Now the company is currently trading around $39. So we could divide this number by $39. We get around 69% on the upside over the next 5 years, not including the 5.7% dividend which you get paid while you wait. And the multiple could end up being much, much higher. It could be 18 to 20 times. I mean, we don't know. We don't know how rates are going to look like 5 years from now. But I would say that there's a very high likelihood they're going to be lower 5 years from now, not higher than they actually are right now, which is why I believe triple net lease, along with Realty Income, both of them actually, they present a decent buying opportunity at such prices. It's not the best bargain in the world, I have to admit. But if you're buying the REITs, and I am buying REITs, mostly apartments, you have to have a small position and be open-minded to dollar cost average down, because you don't know how far the Fed's going to take interest rates. And if the Fed's going to take interest rates to 6.5%, no matter what I say in this video, no matter how undervalued triple net lease, it's going way lower. And this is just the way it is, in my opinion, which is why you have to have an open mind, you have to have patience and some kind of strategy to dollar cost average down if you're looking to buy REITs. We can't predict interest rates, but I personally believe that most of the REITs are trading at fair value, and I really, really like triple net, and this is why I talked about it in this video. Now, the second stock that I talked about many times is sin stock, so a lot of you might not want to invest in it, and I can maybe understand. I don't have this problem, but a lot of you tell me about that stuff in the comments, and it's fine. This is just your preference. And this is BTI, British American Tobacco. I talked about it many times and have an option strategy that I used to use. I share it at the end of the video. But BTI is a very predictable stock. It always goes up something around $44, $45, and then it goes down 31, 32. This is normally when it bottoms, and then it goes back. So that you could do some kind of a covered call strategy that I'm going to share with you. But there's a lot of other people, traders that I know, they just trade around BTI and collect the dividends and stuff. Not something that I do, but a lot of people I know actually do it. But BTI, the sentiment could not be worse. You might have heard that BTI is in a declining industry. Who smokes anymore? No one does that. It's declining. No one is some kind of declining industry. No one does that anymore. This is maybe what you hear. But BTI is much more than just the old school cigarettes. They actually have massive, market share in a lot of what they call the next generation non-combustible products. Something like Vuse, which you might have heard of it. It has a #1 global market share. Pretty popular brands that I know. Something like GLO or GLO or whatever you want to call that is also going pretty fast, or even Velo. It's #1 in 15 markets in Europe. And the most important part is that BTI did not overpay to acquire those like Altria did with Juul, if you remember what they did. Now the stake is worth pretty much zero. Now I do like Altria, and I think it's not a bad investment, but I much prefer BTI over something like Altria. And BTI actually built those brands from scratch, and now they are taking market share. So they did not overpay for some kind of a brand because they were dying to get exposure. I believe they did the right thing, and the company is executing very, very well. But these, what they call the new category or the next generation kind of products, they have been growing around 33% CAGR from 2019 to 2023. So this dying company that you believe is dying actually has a segment growing 33% that's offsetting most of the losses that they are experiencing in the old school cigarette business. And this new category, yes, it's not profitable, but it's getting pretty close to profitability. The losses have been narrowing, and it's about to be profitable in 2024. Their original target was 2025, but now they believe that they can actually be profitable in 2024. And this is eventually going to contribute to the net income and the free cash flow of BTI, which could give it more free cash flow to either something like pay down the debt or buy back stock or even increase the dividend. Now I have to mention this, that one of the reasons why BTI has been so weak in later 2023, around those specific 3 or 4 months, was because the new CEO, and actually the one before him, they were deciding more on paying down the debt instead of doing buybacks, which I personally believe is the right thing to do, because the company has very high interest expense and they are now reducing the interest expense, which is ultimately going to give BTI a multiple expansion. So this is why the stock has been weak, because they haven't been buying back stock. This is one of the reasons, it's not the only reason. But the company is still executing on a very high level. And if you look at the dying, what people call dying, combustible stuff, yes, it's dying in the US. But BTI is much more than the US. They have international exposure across many different countries. So it's declining 7.4% in the US. But in many different regions, it's actually growing 9.1%. It's growing 5%. So the total group was pretty much flat, and they were able to raise prices around 6% because these companies have pricing power. In case of times of inflation, they do very, very well because they can actually increase prices and then use the extra free cash flow to either pay the dividend or even pay down the debt. So it's not such a dying company like you believe, and it's still growing in revenues. It's gonna grow around 3 to 5% organic in 2023 and mid-single digit figure of EPS. So you have an EPS that's growing. You have the non-combustibles growing 33%. You have the combustibles pretty much flat. The company is able to raise prices. And if you look at all that stuff, I mean, what do you believe the company is trading at? Maybe 15 times free cash flow, maybe 10 times free cash flow. I mean, pretty amazing stuff. Very high margins. I mean, I would bet maybe 12 to 15 times free cash flow, but BTI is nowhere close to that. BTI is trading around 6.5 times free cash flow. The dividend of BTI is pretty close to 9%, 8.8%, based on a recent conversion rate between the pounds and the dollar. It's around 8.8% for ticker symbol BTI, pretty close to 9%, 6.5 times free cash flow. Again, I personally believe this is extremely undervalued. I don't know for how long it's going to remain like that. Maybe for another 5 or 10 years, I have no idea, which is why if you're buying BTI, I think most of you are buying it for the dividend, but there's also potential share price appreciation. Yes, they have a lot of regulatory problems, but BTI is much more diversified than Altria in many different countries. So if they face problem in a specific country, in a specific region, they still have other regions to rely on, which is why it's not as bad as being concentrated in only one specific sector. Now, what I used to do with BTI, this used to be my strategy. I stopped doing it for the past few months. But what I used to do, I used to buy BTI below $34 per share. Any price, 34, 36, or it doesn't matter. Below $34 because the stock is very predictable. And then it eventually gets to around $37 to $38. Once it gets to $38, I sell the $40 covered calls for January 2024, normally around 1 year out. And then I sell those covered calls. I collect around a 5 to 6% annual premium just from the calls. So I collect the 6% premium. I'm getting around an 8.5% dividend with BTI. This is something like 13 to 14% return every single year if I don't get assigned. So if BTI goes above $40 and my cost basis is 33 or 34, I could end up with pretty close to 20% return from this dying company like BTI. And then once BTI goes down back below 34 or 33, then I either, buy it again or I buy back the covered call I sold. I talk much more about this in my own investment group if you're interested in watching. But this is something I do with BTI. There's many different things you could do. I think the company is extremely undervalued. They do have some risks. But I believe, the dividend is safe, around the 54% free cash flow payout ratio. So I like the company. I think both of those companies are undervalued. So if you enjoyed this segment, please let me know so I can do another one next month. Thank you for watching. No financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I hope to see you in another video.